Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The US dollar has regained its safe haven status, stock indices have diverged, gold has lost credibility, and Bitcoin continues to slide. Rising demand for safe haven assets, combined with investors closing hedge positions, has strengthened the US dollar. Rising geopolitical tensions in the Middle East, higher oil prices, and fears of a global slowdown are pushing investors towards safe haven assets. But a sharp sell-off in gold is raising doubts about its role as a reliable refuge, driving stronger demand for the US dollar. The fall in Euro-USD has been driven by the worst rout in the US stock market since April's Liberation Day in the US. Non-residents own more than a fifth of US securities. Despite the undermining of confidence in the dollar due to Donald Trump's policies, it is not so easy to abandon the US stock market. Corporate earnings there have grown faster over the past decade than in any other region of the world, and US technology companies don't have many worthy competitors abroad. Foreign investors are increasingly hedging their exposure to US assets by selling dollars. As the S&P 500 declines, investors are reducing equity positions and shifting toward the greenback. The launch of new products by the AI company Anthropic accelerated the rotation in the US stocks. While the Nasdaq index recorded its worst two-day decline since last April, the S&P 500 suffered less, while Dow Jones even tried to update its all-time highs. Software companies' shares fell victim to investors' hot hands. There are fears that the development of artificial intelligence technologies will deal a blow to their business. Traders are speculating about which company's AI will drive out of the market next. Tech giants, including Meta and Nvidia, have also been hit, with investors selling their shares to offset losses from software manufacturers. In contrast, demand for stocks sensitive to the state of the economy is growing. On the 4th of February, the shares of 92 companies from the S&P 500 reached record highs. This is the highest figure since November 2024. Of these, 27 are related to manufacturing, 15 to finance, and 10 to the energy sector. After the most significant sell-off since 1980, gold is attempting to stabilize. Bears argue that the bubble has burst and events will unfold, as they did in 2011. Back then, after falling from record highs, the precious metal entered a multi-year downtrend. Bank of America notes that volatility remains elevated. This allows us to talk about gold as a speculative asset and reduces central banks' demand for bullion. This is especially true given some recovery of confidence in the US dollar. Bulls argue that the fundamentals of the gold market remain intact. US government debt is growing rapidly, which devalues treasuries and the greenback. Political and geopolitical risks remain high. The Fed will resume its cycle of policy easing. Also, precious metals do not seem expensive at these levels. The Dow Jones index exceeded its value by 1.3 times in 1980, and during the dot-com crisis, its ratio soared above 40. Currently, it is just over 10. As a result, Deutsche Bank confirms its forecast of $6,000 per ounce in 2026. Goldman Sachs argues that the risks of exceeding its estimate of $5,400 are high. During his election campaign in the autumn of 2024, Donald Trump promised to make America the crypto capital of the world. The creation of a legislative framework and the adoption of digital assets by institutional investors drove Bitcoin quotes to record highs in October 2025. However, since then, Bitcoin has fallen by more than 40% and returned to the levels seen during the presidential election. Cryptocurrency is no longer politically neutral, and this has undermined confidence. As a result, even the unprecedented fall in gold failed to help Bitcoin. The factor of capital flowing from the digital asset market into precious metals was considered one of the key drivers of the gold rally. Investors did not want to return to cryptos. Bitcoin recorded its longest losing streak since 2018, which gained momentum in February. There is no light at the end of the tunnel yet. The bettors on Polymarket are giving an 82% chance that it will fall to 65,000 and a 60% chance for a dip to 55,000. Another shutdown has delayed the publication of important macroeconomic statistics. As a result, the monthly jobs report will be released on the 11th of February. Bloomberg experts predict an acceleration in employment growth from 50,000 to 68,000 in January, with the unemployment rate stable at 4.4%. 2 days later, U.S. inflation data is set to be released. The slowdown in consumer prices will be a trump card for the FOMC doves and increase the chances of another rate cut in June, and could deal a blow to the U.S. dollar. The U.S. dollar is gaining support as geopolitical tensions in the Middle East escalate. With the risk of conflict between Israel and Iran rising and oil prices climbing, concerns about the global economy are driving investors towards safe haven assets. After confidence in gold was shaken by signs of a bursting bubble, the U.S. dollar is increasingly seen as the safer refuge. Follow the updates on global markets in Pro News Weekly. Like, share, and subscribe.